Hey investors, today I'm going to be talking about Experian. Experian is a global technology and data company credited as one of the big three reporting bureaus alongside Equifax and TransUnion. They operate through two main segments, business to business and also consumer services. Quick reminder, this is not financial advice, only my opinion. You should always do your own research before investing. How exactly do they make money? Experian makes money in multiple ways. First is their data segment, which is around 53% of revenue. This is where they charge banks, credit card companies, utility companies, etc. They then charge them for a volume-based transaction fee or subscription fee every time a business pulls up a customer credit report or verifies an identity. Next is their consumer services, which is around 25% of revenue. This is from everyday people. While the entry-level credit monitoring is free, Experian also offers a $19.99 to $20.99 monthly subscription fee for premium features like identity theft insurance, multi-bureau credit blocking, and advanced fraud alerts. Next is their decisioning segment, 22% of revenue. Experian sells a specialized software as a service or SaaS license, is automated underlying software and analytical tools like their Ascent platform directly to businesses. The software helps lenders instantly calculate risk and automate credit approvals without manual reviews. Now let's kind of look into the financial strength and what their balance sheet looks like. Experian is one of them like sleep well at type companies. It's a high margin, wide moat business. They make tons of cash and have more cash than debt each year, making their debt way more manageable. Their interest coverage ratio is about 14, which means their operating profit covers around 14 times their interest payments. For a company like Experian, that's a pretty decent buffer to have, which is important for a company that does rely on interest rates. Also, it is very asset light, meaning most of the company's earnings flow back into it, and they don't have to spend much on capex or capital expenditure. And there isn't many companies similar to Experian. Their services are crucial for many businesses, and people need Experian, especially for loans. Experian do give back their free cash flow to shareholders though, both through buybacks and dividends, with them offering a buyback recently worth around $1 billion. They have also increased their dividend consistently, minus the pandemic years. Also, with the debt being mostly covered, it does mean the company could go out and do acquisitions of smaller businesses. It'd be more than likely like a fintech or a cybersecurity or a credit company to enhance and improve their offerings. I think their balance sheet is an advantage in itself, as it makes Experian a leaner company, which makes it less exposed to credit rate increases. Next, let's go into their competitive advantages or their moat. Experian is part of an oligopoly, which is a three-way monopoly. This obviously gives them an incredibly high moat. This is one of the reasons why they have such high switching costs. I also think they have a slight network effect, mainly because the more businesses and consumers that use their software, the more Experian can approve its softwares, and thus more people joining it, which makes a cycle. Similar to how Meta does with their family of apps. Before you go think this is some robust AI company, it isn't. It's a software company. It's a slow compounder that will slowly grow over time. Next, AI. Like I just said, it is an AI company, but it does have a bit of AI in its business. In this case, Experian uses AI to work with companies such as Visa and Cloudflare. In simple terms, their AI agent helps them make financial transactions or help verify an identity. The backend is done by Experian. This is pretty big as it could increase the already high margins Experian has, making it even harder to replicate. But in general, this AI agent will help Experian make their business more efficient and more seamless. Next, like many platforms, Experian has a huge user base, around 208 million free users. Even a tenth of that amount would give Experian 20.8 million paid users, which would dramatically increase its bottom line cash flow. Now, similar to other ones, say like Duolingo, it isn't easy to make users into paid subscribers, but it can be done. So with this, they have increased their earnings quicker than its revenue, which usually for most companies isn't really a great sign, but for Experian, as it's a software company, it isn't too bad. It just means more people are paying and staying with their products. In last fiscal year, their EPS increased in around 15%. Not too bad for a typically slower compounder. Next, we have some risks, because no stock is perfect. Valuation. Right now, Experian is trading at a PE of around 21, which isn't too bad, but is still hefty, especially after it followed a 25 decrease in the stock price over the last 6 months and a 35 decrease over the year. So do I think valuation is getting closer to acceptable levels? Yes, I do think so, especially after the drop. Next would be their cybersecurity. While the AI does help Experian automate underwriting, it also does weaponize hackers and bad actors. Even Experian's own data security reporting, they've highlighted unexpected waves of cyber attacks, with criminals bypassing their legal systems and being able to hack the software. This could be a huge risk if Experian don't find better security. Next is interest rates. If interest rates stay high and increase, kind of like the US housing market, it will affect all types of businesses, including the rates that Experian works with. Basically, banks will not want to loan, which will decrease volume for Experian, and that will obviously affect their earnings. Also, regulation is a big issue for Experian, especially for the business. It could be more costly and could suppress margins if certain laws were to go into place. Experian isn't invincible, but unless there's a prolonged period of high rates or regulators do certain laws that affect the business, I don't see them going anywhere in the next few years. Now, after I've said the risks, the main thing that I probably should have went over first, but I like to save until a bit later, is their management. Management for Experian have showed financial discipline over the around last decade and have kept cash high and debt levels low. They've also successfully implemented AI into their platform and have successfully expanded globally. Overall, management is good, but like always, there is risk with them and negatives. Firstly, is obviously the constant regulatory changes, especially around data collection, that could affect the company's earnings. Also, with the free trials, users have had issues with them, mainly after having to pay a subscription even though they just signed up for the free trial and it had not run out. Along with that, they have faced lawsuits, one of them being from the Consumer Financial Protection Bureau, or the CFPB, alleging the company failed to properly investigate and clear up credit report errors submitted by consumers. They've also had very aggressive upselling, with free accounts being bombarded with constant ads offering loans, credit cards, etc. And finally, I'll say they don't really have the best customer support, with users citing as slow, unhelpful, or completely unresponsive. In my opinion, this gives me a mixed management. Like, they're good, but they also have risks. They're disciplined, but they're not making the app as good as they could if they focused on it. I think with the cash they have, they could definitely improve and maybe optimize their platform in certain ways. Now let's go over some recent acquisitions. Ilion. Experian paid around $820 million. This acquisition nearly got blocked but was able to go through as courts saw Equifax still held a dominant monopoly. This acquisition helped Experian expand into Australia and New Zealand markets. RefJet, or RefI, as a joint venture. This company helps consolidate consumer loans and gave Experian a lot of debt data. But not all acquisitions went through. ClearScore, which was a highly popular UK financial tech startup that disrupted the industry by offering users free credit reports and scores. The deal was worth around £275 million and was blocked by the UK antitrust regulators as they felt it would be completely monopolistic and said that Experian would artificially raise prices. To be honest, I do agree with regulators. They probably would have raised prices if this acquisition went through, but it does show that Experian are willing to pay big just to keep their pricing power. Now, if you made it this far, thank you so much, and honestly, it means a lot. But I'm going to give my final opinion. Currently, I think Experian is finally trading at a valuation I think it deserves. I think anything above the 23-24 PE ratio range was a bit too much and was a bit of a premium. Experian is no Google or Meta, so I don't think the credit bureau should trade at a tech stock level. I also feel that the risks they face are worth taking long term. I think unless management make a huge mistake, I don't see the company going anywhere. But the risks aren't something to gloss over. These risks, if not attended to, could cause customers to walk away, especially free customers, who firstly are the bulk of their customers, who secondly don't have anything to lose if they were to cancel. That is all for me today. Thank you for watching, and I'll see you in the next one.